This is a 30-plus year record of capital miscalculation, a slow motion distortion on how market price risk, growth, and reality itself. What you're seeing here is the price to book ratio of value stocks relative to growth stocks inside the Russell 2000, the Russell 1000. And the message is brutal. Value has been systematically repriced lower for more than 2 decades. Not because fundamentals collapsed, but because policy, liquidity, and narrative crushed it. This is a chart of an era. From 1990 to 2024 is the price to book, meaning how much you're paying for the price of a stock versus the book value of the stock. And obviously, it's getting crushed, meaning we're willing to spend more and more and more beyond the value, the book value of the stock. So let's define the axis. When the ratio is high, value stocks are expensive relative to growth. When it is low, value stocks are cheap relative to growth. In the early 1990s, this ratio sat comfortably around 0.4 and 0.5, as you could see. But now, it is changing. The early 90s, the ratio is at 0.4, 0.5. Now, then comes the late 90s, the tech boom, right? And you could see that the ratio collapsed as growth was bid into the stratosphere. And the value was left behind. And the dot-com crash, something important happened here. Value didn't just recover, it overshoot. By the early 2000s, the ratio surged to 0.6, a full reversion plus excess. This was the last time valuation discipline truly mattered. Now, focus on what happens next. For roughly 2004 onward, the charts begin a persistent downward sloping channel. Not cyclical, not noisy, not random, a structural decline. Every rally in value is weaker. Every peak is lower. Every recovery fails faster. This is not a market accident. This is a result of zero interest rate policy, quantitative easing, asset price targeting, suppression of discount rates, and the finalization of narratives. When capital is free, duration wins. When rates are suppressed, future promises dominate present assets. When central bank remove downside, speculation replaces valuation. I mean, what's going on right now with the Fed? I mean, they just basically saying, game on. We are going to keep rates low. We are going to keep the dollar weak. We are going to keep repaying the debt by refinancing. We are going to keep the party going. Growth stocks became bond proxies, infinite duration assets in a world where discount rates were engineered towards zero. And value stocks, like banks, energy, materials, and industrials were treated like obsolete relics. A bank? Who wants to invest in that? And then the reason price to book matters, right? Why does it matter so much? Well, book value represents tangible capital, accumulated profits, infrastructures, and real assets. So when the price to book collapses, you are paying almost nothing for replacement cost. You are ignoring the balance sheets. You are assuming assets never matter again, and the assumption that only being true under one condition: artificially low interest rate. The chart is effectively a shadow yield curve. As rate fall, growth is being bid up. As liquidity expanded, valuation discipline evaporated. And the market learned one dangerous lesson. You don't need cash flow, you just need a story. At the end of the day, security analysis is about telling us stories. What's going on? For example, what's a story about Tesla? Well, Tesla is going to make robots. Tesla is an AI company. Wow, okay, let's pay 150 times P ratio for Tesla. Does this make any sense? Central banks stepped in as permanent buyers of duration. Risk premium was compressed, volatility was suppressed, capital was herded into the same narrow trades, and mega cap growth. Platform monopolies, intangibles, heavy balance sheet. By the late 2010, as you could see, the ratio was approaching 0.25. That means growth stocks were trading 4 times the price to book multiple of value, and markets treated as normal. This is not normal. This is policy autocraft. Then came 2020. Remember 2020? Zero rates, unlimited QE, fiscal dominance. The ratio collapsed towards historic lows of 0.2. No one cares about the book value. Speculation exploded. Meme stock, unprofitable tech, narrative investing, anything tangible was dismissed as old economy. But notice something critical. Even during the 2022 inflation shock, when rates spiked, value never regained its former relative valuation. The bounce was weak. The trend line held. This tells you something unsettling. Markets are still pricing growth as structurally superior even in a high-rate world. That belief is fragile. So this is not a backward looking. This is a warning, okay? Because price-to-book compression of this magnitude historically ends in one or two ways. One, a violent re-rating of value upward, and two, a prolonged destruction of growth multiples. Either way, the status quo does not persist forever. You cannot indefinitely price productive assets below replacement cost while pricing distant cash flows as if risk does not exist. If rates stay higher for longer, if capital becomes scarce, if earnings matter again, this ratio does not drift lower. It snaps. And when it snaps, it doesn't move politely. This chart is the autopsy of the last monetary regime. It tells you exactly how you got here. Cheap money, narrative dominance, and the abandonment of valuation discipline. But it also hints at what comes next. Because the most hated asset class in a distorted system is usually the one that survives a reset. Think banks. Think utilities. Values hasn't disappeared. It has been suppressed. And suppression always ends the same way. Not with a smooth adjustment, but with a reckoning. Watch this ratio, because when it finally turns, it won't be a trade, it will be a regime change.